Welcome, everyone. Thanks for coming out to our webinar tonight. I'll be talking about reverse mortgages and all of the unique and different ways that you can utilize a reverse mortgage. A lot of people understand the standard methodology of when and why to use reverse mortgage. I'll be going into some more intricate details, some creative examples, and some recent examples of situations where we helped people expand or even just optimize their portfolio with looking at reverse mortgages. So lots of cool things to talk about. Reverse mortgages is becoming a lot more popular and a lot more common than what we've seen in the past. So I'll go over some of the basics, typical uses, creative uses, the myths and facts, options to finance, what the home equity looks like over time, some examples, and then we'll go into a Q&A so we can make sure that any questions you have are answered. So first, let's go into what a reverse mortgage is. It is a loan secured against the home and is designed exclusively for Canadian homeowners that are 55 years of age and better. It provides access to up to 55% of your home value, and the money is tax-free, so you don't pay any income taxes or anything like that. There's no impact on government pensions or anything like that. The nice thing, of course, with a reverse mortgage is that no payments are required. And so this is actually why you call it a reverse mortgage. A typical mortgage means that you're getting a mortgage and you're paying it down. You're paying down principal and interest every single month. A reverse mortgage means that the amount that you actually owe is going to go up over time because you're not making a principal and interest payment every month. So the amount that you owe is going up. It's going in reverse versus a typical mortgage. And one of the things that's really important is you do maintain ownership and control of your home. A mortgage is simply a loan secured against your title, just like a standard or typical mortgage. And one very important point is that you will never owe more than the home value with the lenders that are currently available in the channel anyways. And this is something that we've seen a lot of people question or worry about is, well, will I owe more than my home value? And the answer is no. Canadian lenders are very conservative. And they do not like to put people into positions where you will owe potentially more than the value of the home is worth in the future. And so realistically, the way that they look at this is the reason that they set it at a certain age is that if the mortgage amount is going to increase over time, they want to make sure that they're limiting that amount of time that the loan can increase. And that's why the minimum age for any of the borrowers minimum age is 55 years old. And so if one person's 50 and the other person's 58, then they would not qualify because it's always looking at the youngest person and how long they may expect to live. And so this is important to think about and consider. But essentially, a reverse mortgage is a mortgage where there's no payments and therefore the loan is slowly increasing over time. And qualifications are very different, i.e. there are very little qualifications for this. Even on the credit side of things, they don't look as much at credit. They don't look at income at all, other than just ensuring that there's enough income to support the property taxes and whatnot. And so it's quite simple and straightforward. And in fact, we do see a lot of the time people are using this to actually pay off debts and just improve cash flow. So effectively, the most common use anyways for reverse mortgage is just to produce additional cash flow. And sometimes this is by paying off other debts that have accumulated. Sometimes this is ensuring that if there's any renovations or repairs necessary to the property, those are covered off and there's no payment necessary to pay that back. Also ensuring that you're not decreasing the value of assets you have that are earning you an income. And you can continue to have those assets earning an income for you on the other side. In addition to that, one of the cool things about some of the reverse mortgage lenders is they can actually provide you with a monthly cash flow in addition to a lump sum. So you don't have to just take a lump sum on the reverse mortgage. You can also have them provide you with a monthly income. In fact, believe it or not, don't laugh, but there's actually a lender out there that provides you with a card that you can use. So you can actually go ahead and tap your home equity away. Of course, we don't recommend that you use it on consumer goods, but for some people, it's very convenient, the ability to be able to use a credit card at any credit card terminal in order to make payments, and it goes on to your mortgage, and it just slowly increases over time. So they're getting a bit more creative with how you can access your home equity. So the idea here is that it is really helping people stay in their homes. With a reverse mortgage, is really the primary intention is to enable people to say, okay, well, it's getting more difficult now. You retired, your income is lower. Perhaps you have an existing mortgage already, and now that you've retired and your income is decreased, maybe it's harder. Inflation, of course, has been a major factor. Things are getting more expensive, and so this is an area where if you have a mortgage and it came up for renewal and the rate's much higher, and you're finding that food and groceries and everything else is getting more expensive, this is really where a reverse mortgage may be an effective tool to really get the cash flow under control. And it's effectively providing an alternative method of qualifying. And the reason for that is that income is not a factor. So they're not really looking at the income unless you're carrying a lot of other debts, et cetera. Primarily, it's just more about ensuring that there is enough equity in the home for you to qualify. And they do look at, what the value of the home is, how long the expected life expectancy is, and determining what the maximum amount is for that. And so this is what we typically see for normal reverse mortgage situations. And of course, there are lots of creative solutions too. Some of our clients will use a reverse mortgage to invest in real estate. And so yes, of course, it seems a little bit odd to borrow money on a reverse mortgage. And yes, interest rates on reverse mortgages are typically a little bit higher than a typical mortgage. But what some people are doing is they're borrowing money against their home and then using that to purchase a rental property. And there's no payments on the reverse mortgage. They're earning cash flow on the rental itself. Now they have both their home and a rental property appreciating over time. And probably one of the coolest thing about this is that although you're not making payments on the mortgage, there's still interest that is accumulating. And whenever you've borrowed money to invest, the interest portion of the payments is tax deductible. And so what happens is you're able to then look at and say, well, actually still $100,000 or $50,000 of interest accumulated on this loan that was borrowed to buy this rental property. You get to use that interest and write off against the income on the rental property itself to reduce your taxable liability. Of course, I always say, make sure you talk to an accountant, make sure that you get advice that's right for you. But this is a really cool way of not only just kind of winding things down a little bit into retirement, but you could use this as a way to actually continue to grow your portfolio entering into retirement. Income qualifications are not a problem because they're not really looking at that. And if you're buying a rental property, you're actually creating more income for yourself and also acquiring more assets at the very same time, which is a really cool way of structuring something. Another way that I've seen this happen a lot is an early inheritance. So a lot of the time what we find is that kids nowadays, they're trying to buy their first place. Very difficult, very hard to do so. And it could be kids or grandkids, by the way. And what we're finding is a lot of the time people say, well, eventually that money is going to get passed down to the kids and grandkids, but it may take quite some time before the individual sells the home or passes away, et cetera. And so instead of waiting for that moment to happen and then passing funds along to the kids, one of the ways that some of these people think is, well, why don't I just put a mortgage on my property and then I can give the kids money? But the problem with that is that there now triggers a payment, and it's often a payment that the individual can't afford. And it also is a payment that the kids can't afford either. And if they borrowed all that money between the down payment and the mortgage itself, then they can't afford it. So this is another method of using it for an early inheritance. And so because it's very difficult to qualify for mortgages, and of course, real estate is very expensive today, one of the ways of doing this is the parents or grandparents that plan on handing down funds to the kids eventually can put a reverse mortgage on the home. And then instead of having to sell it to unlock the cash, instead you just put a reverse mortgage which unlocks the cash and then an equity gift. And again, there's no taxes on the reverse mortgage itself. And then parents or grandparents can then do an equity gift effectively down to the kids to then buy their own home. And the interesting thing about this is that, yes, in theory, by putting a reverse mortgage on the property that eventually will be resold through the estate, the equity in that property will slowly erode because there's now a mortgage secured to it and a reverse mortgage at that. However, on the flip side, now the kids or grandkids are able to start to build equity in their own homes. And so they get to kind of kickstart their lives instead of waiting. In some cases, it's kind of interesting. In some cases, there may be somebody who's 90 years old and they have kids that are in their 60s. Like, do the kids in their 60s really need the money? And in fact, there are, perhaps grandkids that are in their 40s, and does it really make sense for them to be waiting longer to get a kickstart in their lives and be able to buy their first home? So in some cases, you can kind of shift the time horizon a little bit earlier. And if the equity in the estate home is going to slowly erode over time, well, at least the kids and grandkids are building equity in their homes during this time period and starting to kind of get their lives going. So we're starting to see this is becoming a more popular option in order to accelerate that motion. And the last thing is on the equity lending side of things. And so there's lots of situations where individuals just simply cannot qualify for a mortgage in the traditional sense. And usually when you look at equity lending, usually it's very expensive. We have to go to private lenders or B lenders, and then the rates and fees, et cetera, are quite high. Interestingly, reverse mortgages are effectively equity lending, but at usually better terms than B or private lenders. And so it's one of those areas that we found that if you meet the criteria, it could be a better fit than B or private. Obviously, of course, it depends on the situations and circumstances, because they're really just looking at what the age of the individuals are that own the property and the property location, type, et cetera, to determine how much money this person will qualify for in the mortgage. So very different structure. So there are a couple of myths that we should talk about as well. One is that the bank owns your home. Well, the bank only owns your home as much as they would if they had a standard mortgage on the property. So it's just still a secured mortgage, just like any other mortgage. There is no real difference as far as the security is concerned. Now, one of the concerns as well is that they might owe more than the home is worth. And in the US, back in, I think, the 80s in particular, and beyond that, there were definitely some companies down in the US that gave people money that they shouldn't have given money to. They lent them too much money, and they lent it at very high interest rates. And if they went upside down or underwater, then the company would actually go after the individuals and say that, hey, congrats, grandma's home sold, but she owed more than the home was worth, and so you now need to give us $50,000. Lenders in Canada don't do that. They don't do it that way, and they don't play that game. So I don't think it's very reasonable for the banks to do this. They're very conservative with their lending. They don't go above 55% of the value of the home, and they ensure that there's never going to be a situation, or a very, very minimal situation, a risk of it, that the loan amount will exceed the value of the home. In fact, I saw a stat the other day that one of the lenders posted, and about only 1% of their portfolio was in a situation where the borrower owed more than the home was worth. And those are extreme cases, maybe a certain market where the home values didn't go up, a situation where maybe the home wasn't being taken care of in a good way, things like that. And so it's very rare that the lender eats it, but the lender has a lot of money. It doesn't make sense to put the risk on the homeowner and the borrower to be potentially in a position where they might owe more money than the home is worth. And so instead, in Canada, the banks decide to just say, you know what, we'll eat it if we're owed more money than the property's worth. We'll just cap it at the amount of the sale price. Another myth is that they are the lender of last resort. I've actually been finding, I'll give you some examples later in the presentation. I've actually been finding circumstances where they're actually not the lender of last resort, and that we actually had different options available to our borrowers. Our clients are choosing the reverse mortgage over other options. So of course, I know the feeling. I know that people don't want to feel like they're going backwards and they're eating into their home equity. You've worked very hard to pay down the mortgage, and now it seems odd that you'd be going back in reverse. But there's a certain lifestyle to be sought after, and worrying and penny pinching every single month. What kind of life is that to live, right? You want to make sure you're enjoying your life, and whatnot. And so it is something to look at. And from as far as being a lender of last resort is concerned, in many cases, even the interest cost is still cheaper than alternative financing options, and so they're not necessarily a lender of last resort. And then the last myth that I wanted to address here too is the bank can force to sell the home. Well, there's no payments. In fact, it's harder in general for a reverse mortgage lender to foreclose than a regular bank, because if you had a regular bank mortgage and you stop making the payments, then the bank can actually foreclose on that property. Whereas a reverse mortgage, there is no foreclosure process in that situation because there's no payments. And so the bank can't force you to sell the home in those type of circumstances. So there's a couple myths that I wanted to address and go after here. So I do want to go over a couple of in-depth examples and some more data and information here to give you an understanding. So let's just go through, and I know that this is a small loan amount, and we could do it for a larger loan amount too, but this is the example that was given. By the way, interest rates for reverse mortgages currently are much lower than what this chart is showing. So this chart was done, I think this was initially done last year, and rates have come down about 2% overall for reverse mortgages, maybe 1.5 to 2%, depending on the situation. So just a heads up that the interest rates shown here are lower currently than what this chart is showing. But in the reverse mortgage situation, let's say that started off at $25,000 and the home was worth about $1.2 million. If that mortgage loan was continuing to accumulate and increase over time, you can show that the amount of interest that accumulated in year one was about $2,800. And the mortgage is now increased up to $42,000 because the principal and the interest is being basically added on top of that amount, and so it's slowly increasing. Also, what you're going to notice too is that that there's a monthly amount that's being added to this too. So the borrower is also receiving $14,400 per year, so $1,200 a month in additional income, which is another factor. And so we're showing that a $25,000 loan plus $1,200 per month extra per month on a monthly basis, just for expenses and everything, is that the home value is going up, and it's actually going up higher and more than the interest and the balance on the mortgage itself. And so over time, over a 10-year period in this situation, we can see that the year-end mortgage balance has increased all the way up to $289,000. But the net equity has gone up from 1.175 million all the way up to 1.487 million. And again, smaller loan size that we're dealing with here. But in theory, then, if you looked at it, in theory, if you borrowed, let's say, $600,000, if the home value increased by about 4% per year and the mortgage rate was about 8% per year, then eventually over time, you'd see that the amount growing on the mortgage would be about equal to the amount growing on the home value. And so, the lenders have kind of set it up in a way where they generally are not in a position where they think they're going to be upside down in the future on their mortgages, and they're designed in that way. And so in that example that I looked at, the previous chart here, you can see that the home equity amount is actually slowly increasing. And yes, the reverse mortgage amount is increasing over time, but not at the same rate. And we will see some cases, by the way, where the amount of the reverse mortgage is increasing faster than the home equity is increasing. And so the amount of equity may shrink over time, but it's very unlikely that it'll get to a point where more will be owed on the mortgage than what the home value is worth, especially in areas like Vancouver where the home values are quite high. There's a lot of equity to erode. Something I wanted to talk about is the true cost of down payment. So in some cases, we have people that are looking at maybe downsizing or buying a property or whatnot, and they're looking at potentially liquidating their funds to do that. Or maybe they're trying to help out kids or grandkids, and they're going to liquidate their funds in order to do that and to help out. So a couple of things to look at here. So let's say that you had money in an RSP or a RIF. You might be getting anywhere from, let's say, 2 to 10% return on that. If you have money invested in the stock market, multifamily properties or something like that, maybe you're getting 5 to 12% return. Bonds or GICs, 3 to 5%. Of course, lately it's been closer to 5%, but historically it's a little bit lower than that. And of course, cash is generally at zero. And then the investment return of owning a home, you can use anywhere from 3 to 4% annually. 4% is much closer to the average. In fact, last 25 or 30 years has been higher than 4%, closer to about 6%, but let's assume that we use about 4% for now. Now let's look at the tax component here. If you had an RSP or RIF, then 100% of that income is taxed as income. So it really depends on your tax bracket. It could be anywhere from 0 to 47%. If you have stocks or mutual funds or properties or anything like that, and you were to sell it, there's capital gains. And of course, capital gains has now changed and is now a little bit more expensive than 25% in some cases. but you'd be paying at least 25% on the capital gains. If you have money invested in bonds or GICs, then 100% of it is taxed on the interest earned. And then cash, if there's no return, there's no tax rate. And if you're pulling money out of your home, then there's no tax. So the opportunity cost is really about 2 to 10% on the RSP, on the stocks or mutual funds, et cetera, 5 to 12% bonds, GICs, cash. And if you borrow against your home, the opportunity cost or interest cost is about 5 to 9%. So depending on exactly where the reverse mortgages are at, and by the way, there is a reverse mortgage lender, actually a few of them that are offering a low introductory rate of 4.99% for the first year. So there are options and whatnot for fairly cheap money on that side. And so the total cost, really, when you start to look at it, if you start to factor in the investment return, the opportunity cost, and the interest that and taxes you'd be paying to borrow money and take out money, if you were to give money to somebody or use that your RSP or RIF to use for a down payment, either for yourself or somebody else, anywhere from 2% to 57%. And the cost per dollar that you borrowed is anywhere from 2 cents to 57 cents. If you're doing this with stocks or mutual funds, et cetera, it's 30 to 37%. If you're doing bonds or GICs, really depends on the actual return. If it's sometimes bonds or GICs are as low as 1%, so it might be as low as a cent to 5 cents. Cash, of course, is 0. And then on the home, that total cost after taking out the investment return, it's really only costing you 1 cent to 5 cents once you kind of factor all that out. So the long story short of it is, when you're looking at it, it doesn't always make sense to liquidate investments you have that are earning an income for you if you can pull it out of your home, keep your home, and use a reverse mortgage effectively. So a couple of things that I also wanted to go into, and some examples of what I've been finding. There's a lender that we've been using quite a bit for what I call a pre-reverse mortgage. And so you can actually get a product that is very, very similar to a reverse mortgage. And what they do is they'll give you a line of credit limit. The rate is anywhere from prime plus 0.5 to 0.75%, depending on your qualifications. So their net worth programs is a bit of a higher rate, whereas their standard program is a bit of a lower rate. And they give you an approved limit, and that can be based on your net worth. And then there's no payments as long as you have available limit and you haven't reached the limit. And once you reach the limit, then you do have to make at least interest-only payments. And so, for example, what we've been doing, and I just worked on a situation recently where we were able to get a limit that was about $550,000. We're starting off at about $220,000. And it looks like we could make no payments on it and slowly allow that number to increase over time. We could allow that to increase for 8+ years before any payment would need to be made on it. And it's fully open. It's a line of credit. There's no prepayment penalties to totally pay it off if you were to sell the property. And so sometimes with people that do have equity and can still qualify for a mortgage of some sort, you find that this option is a little bit more flexible, a little bit cheaper. And you can actually still make any payment you want on the line of credit every single month. And then the rest that you don't make will just get added to the principal. Now, this brings up an important point too, that reverse mortgages, most of them still allow you to make a regular payment if you want. So every month you can say, you know what, even though the interest is $3,000, I'm going to make $1,000 a month. I can afford that. And so you don't have to allow the reverse mortgage to accelerate as quickly if you choose to make a payment of some of the interest. We've used this on a couple of occasions now to qualify for another mortgage. So a reverse mortgage means that there's no payments on the property. So if we had a client that had a residence and a rental, and both mortgages were coming up for renewal at the same time, and we just couldn't find a way of doing this without going into higher cost lending to restructure the portfolio, re-amortize the loans, get lower interest rates, lower the payments, and just put them in a much better position. And so when we looked at the numbers, we realized, well, if we put the residence into a reverse mortgage, now there's no payments on it. And then the rental, now we can qualify the rental, redo the rental property. If we wanted to, we could have brought up the loan amount, and then we were able to re-amortize it, get a better rate. And we found that the difference in payments, there was a significant difference of at least, I think, about $4,000 a month in cash flow. And so by redoing the residence of the reverse mortgage, we're able to save money in cash flow. And the difference in interest costs was actually very similar because other options to redo it would have resulted in higher interest rates. So it's a very good solution. And then interestingly, after doing that for that client, I had another client that I was working with that had a large line of credit and a second mortgage on the residence, and the payments were very high. I think it was over 10 grand a month. And the only real option to restructure everything was to go with the B lender, which would have been a higher rate, would have been fees and everything. And it still would have had a monthly payment every single month. Instead, after we did the other deal, I'm like, oh, wait a second, we can actually do the same and apply the same thing here. And so we were able to put the residence into a reverse mortgage, saved over 10 grand a month in payments. And then by doing that, by eliminating that, we actually were able to also qualify another property. We were able to bump up that loan amount and get a little bit of extra cash just for other living expenses and cover a couple of other things. And so we were able to restructure the entire portfolio in a much better way. And I must tell you, it relieved an immense amount of pressure off of the borrower's shoulders, because it was just really tough to continue to run the business and make enough money to sustain and to pay those payments. And what didn't really want to be looking at selling the home or downsizing yet. It's probably something that's like at least 5 or 10 years down the road at minimum. So we really like that option in order to restructure things and of course in this case we actually also saved money and interest, and we have no payments, so it was a win-win in many regards. Now that being said, there's always pros and cons, and so we want to make sure that we're understanding what the pros and cons are. And so the pros are you do qualify based on equity, get to stay in the home, there's no payments, and of course there's many other pros that we had talked about before too. Now, there are some cons. The interest cost is higher than a traditional mortgage, so that's something to keep in mind. Also, the penalties can be higher in the first few years than a traditional mortgage. So most of the lenders will charge a percentage of the loan amount, and that percentage decreases from years 1, 2, 3, 4, 5, etc. And some lenders will charge a certain number of months of interest for the first few years. And generally speaking, they will either waive or half the fees if the applicant was to pass away or they were to go into a home of some sort. So there are some situations and examples where they may be able to reduce those costs and penalties. But in general, the penalties are higher to break this, and so it's not a great short-term solution. If you need a short-term solution, then that's maybe where the pre-reverse line of credit can be better because there's no penalties to paying that off. And another con is the maximum is 55% financing. So you might find that that's just perhaps not enough. So that's something to keep in mind when you're looking at this. So if you do want to figure out your qualifications, you can always email us at info@greenmortgageteam.ca and we can give you some more feedback. We'll let you know a couple of questions and we can give you some ideas of how much money could be accessible. We've seen a number of people. In fact, a lot of our investor clients are going to their parents and saying, hey, by the way, if we open up some equity in your home, we can get access to that money and then use that to invest. We can use that money to then maybe do some private lending with or something else to generate some cash flow, maybe buy a rental property, lots of different things you can do with the money. Financial planners are very intrigued by the idea too, because if you can technically earn a higher rate of return on the investments than the cost of borrowing money, then that also sets you up for success too. So obviously, it's riskier when you're borrowing money to invest, but the nice thing is it's not negatively impacting the cash flow in any way, which is really good. So if you do have any questions, feel free to reach out to us. We're on Granville Street in Vancouver. You can email us at info@greenmortgageteam.ca or visit our website at greenmortgageteam.ca or call us at 604-229-5515. So what I'll do now is I'll open it up for some questions. Does anybody have any questions that they'd like to ask? You can put it in the Q&A or you can also put it in the chat. I believe that the chat has been enabled, so everybody should be able to type in any questions that they have into the chat too. No questions? You guys are taking it easy on me. Well, if there aren't any questions, then I'll wrap up the presentation here. Thanks so much for coming out. I appreciate all of you. And here we go. There's one question in the Q&A. Okay, great. Yeah, of course, you're welcome. If there's no other questions, then I'll wrap things up here. Feel free to reach out if you have any questions in the future. And I know that the reverse mortgages, there's a lot of questions, a lot of things to think about. We do have a PDF that we've put together that has more information about reverse mortgages, getting into a bit more of the nitty-gritty details. So feel free to reach out if you'd like a copy of that. And otherwise, have a great rainy November. Oh, there's one comment here. If kids want to renovate but can't afford it, is this the best way to go? So it's not necessarily the best way to go for renovations if it's not a large loan amount. It really depends, to be frank, Annette. I think that's something that we'd have to look at a bit more specifically. But it can be, especially if it's a larger renovation. Oh, there's another question here. So for the lender, it is an investment in equity for the future. Try to understand the upside for the lender. Yeah, exactly. So the lender is expecting that they will be able to earn an income in the future eventually when these loans are being paid out, because they're not getting paid out on a monthly basis. So and that being said, lenders do make investments like this all the time. In fact, sometimes what happens is a lot of this money will come from large insurance agencies, because insurance companies are in the opposite, where they collect money on a monthly basis and then they pay out at some point a large amount in the future. So it's kind of the opposite. So sometimes we find the insurance companies are the ones that often invest in this, because they have a whole bunch of money coming in every month and they have to pay out future money. And then the opposite, they can then lend out that money that they have now, and then they'll eventually receive the money in the future. So it's kind of an interesting circumstance. So the question is, what is the normal premium on a reverse mortgage? So generally speaking, the rates are about 2% higher. Again, there is a promo right now with a few lenders where it's only 4.99% for a 1-year term, which is actually cheaper than bank money, but they're expecting that you'll renew the mortgage and then go to regular rates at that point. So generally speaking, the rates are about 2% higher than a standard mortgage, which is about the same or slightly less than the premium that you would pay if you're going with a B lender. And the question is, sorry if I missed this, when are they expecting to get paid at the earliest? So when the home is sold, that's generally the earliest point that they're getting paid back. Or if you decide to make payments, you can make payments if you choose to. And good question, Tamara. So the pre-reverse is not requiring you to be the age of 55. It can be at any age. And so it's just a line of credit product that does not require a monthly payment. So it's quite flexible from that perspective. Very good. And then there's another question. If I'm subdividing, is a reverse mortgage still an option? So it can be an option. However, it may not be the best option for you. And so we need to make sure that the reverse lender is okay with you subdividing. And usually what ends up happening if you're subdividing it. So I'll explain how a regular bank would look at it. And then I think we'd have to take a look at whether a reverse lender would be okay with it and how they would structure things in the future. But generally, you're subdividing 2 lots or a lot into 2 or more. What happens is once it's subdivided, in order to be able to get the approval to split it, the bank has to be on side, and sometimes the bank will say, we'll just have what's called an inter alia mortgage secured over both lots. Or sometimes the preference is to say, well, if there's enough equity on the one lot with the house on it right now, then you can get the other land piece free and clear, and you can just sell off the land without having to have any encumbrances on it, so no mortgage on it. And in that case, you have to make sure you're not exceeding the loan to value that the lender requires on the remaining lot plus the house. Because generally the lot plus the house for half of the lot is usually less than the house on the full lot. So they just have to make sure that that's in line. I've not gone through that with a particular lender as of yet, but that's typically how a major bank would do it, and I expect the reverse lenders would be in a similar vein to that. But we want to make sure that that's discussed in advance. Yeah, and then Mert, your point is kind of interesting, but yeah, you're interesting that they didn't expect them to be okay if you happen to live that long, but that's because they are doing all of the work. It's an actuary basically in the back end that says, okay, well, we're only going to land up to this amount because we expect that people will generally live this long. And so of course, in theory, If you lived until you're 98 years old, then it's possible that that loan could be upside down, but it's extremely rare. And the interest rates and loan amounts and whatnot would have been high, and the appreciation of the property would have been low. It's just very rare for that to happen. Hey Chris, does a reverse mortgage only apply to a principal residence? So with most lenders it does, or it's residence plus they will inter alia it over a rental as well. So you might be able to stretch it over and above that. Hey Bryn, can the reverse mortgage be an investment or income property? Does it need to be principal residence? So yes, it does need to be a principal residence. Some lenders will allow you to stretch it over a residence and a rental, however. So you can kind of stretch it over both, which gives you access to a little bit more equity if you do it that way. But the residence has to be at least attached in either scenario. Some lenders only use the equity in the residence and not any rentals. However, on the flip side, you could borrow a bunch of money from the residence for down payment on the rental. And then it may be easier to get a mortgage on the rental property because if the rental income is sufficient to cover it off, and there's no payments on the borrowed down payment portion on the residence, then it may be easy to qualify for a standard mortgage on the rental for the remainder if you needed a top up. Andrew asked, what happens if the real estate market crashes? Well, that's the lender's fault, or the lender's circumstance that they have to deal with, and so that's really up to them. And they're the ones that eat it if it really collapses. So if the home value drops below the loan amount and the property is sold, then they eat the loss, not the borrower. Awesome. Any other questions, guys? Okay, well, I'll wrap up things. I'm glad we gave it an extra minute. All of a sudden, it took a couple of minutes, and then the questions started to fly in. It takes some time sometimes to think about the questions. So I'll wrap up the presentation from here. Thanks so much, everyone. Good to see you, and we'll talk again. And feel free to reach out if you have any further questions. Okay, thanks so much.